Welcome RIAs and wealth advisors to our discussion today on building and preserving your clients' wealth with farmland. My name is Rani Ramchandani. I'm a senior associate on the investor relations team here at Farmland LP, and I'm joined today by two of my colleagues, our founder and managing partner, Craig Wishner. Craig has 35 years of experience in real estate and tech. He founded Farmland LP in 2009 to turn farmland into a high-performing, organic, and regenerative asset class. He is now responsible for the investment activity and the business strategy of the firm. I'm also joined by Tom Sullivan, our Managing Director of Capital Markets and IR. Tom's been with the firm for 5 years and brings nearly 3 decades of experience, capital raising experience. He also has a personal history with real estate investing, including student housing and multifamily development. So this is our team. Craig Wishner, he's also on video, and Tom Sullivan, and myself, Rani Ramchandani. So we are one of the largest farmland managers in the US, focused on organic and regenerative farming. We have 300 million of assets under management and 18,500 acres of pristine farmland across 3 regional hubs. We service these hubs with a dedicated 55-person farm management team, and they're mostly based in 3 of these regional hubs. You'll also find some overlap with them. And we're doing all of this at scale. We also have an amazing 12-person team based out of Larkspur that manages all the fund activity. And we're currently raising a 250 million Fund 3, and we expect to close that in the next few months. Now, you may have heard about us or read about us on one of these publications, or perhaps even heard about the growing regenerative trend in farming. In fact, and this is not out yet, but we've been named the Farmland Fund Manager of the Year by a leading industry publication, and we look forward, rest assured, to sending that to each of you once it is announced. We have found that clients of RIAs are actively seeking exposure to farmland. And over the years, we built strong relationships with 57 of those RIAs and wealth advisors. In fact, our largest RIA relationship has we would love to have over 300 clients, close to 100 clients in all 3 of our funds. Our fund is also available on major custodial platforms, Pershing, Fidelity, Schwab, making it easily accessible for RIAs and their clients to work with us. We're also increasing our exposure on other alternate platforms such as AI Insights, now known as iCapital Insight, and Realize Impact. That's a platform for investors who'd like to make impact investments using their donor-advised funds or a foundation. So today in this webinar, we have an agenda. We'll be exploring the key drivers of wealth, the rise of alternatives, and why farmland is a leading performance component in a diversified portfolio. We'll also jump into Farmland LP's Fund 3, which we look forward to sharing, and then a Q&A section at the very end of the presentation. So that said, please welcome me as I introduce Tom. I'll hand it over to you, Tom, and we'll talk about the role of alternatives in your clients' portfolios. Thank you so much.
Yeah, thanks, Ronnie. And let's start by taking a look at how different categories of investors allocate their assets. Traditionally, the wealth allocation models have been very focused on liquid assets such as stocks and bonds. So as clients increase their net worth, their investments in alternatives also increase. You'll see here at the top that the lower net worth tiers really concentrate their assets on tangible assets like homes and vehicles and retirement accounts, and they really have minimal exposure to alternatives and equities. As your net worth increases, however, these portfolios begin to shift and become more diversified with a larger allocation to mutual funds, to stocks, to real estate, and certainly business interests become more important. So why does this occur? Why is that shift there? One of the reasons is the more wealthy investors are really looking for a hedge against inflation. They're looking for portfolio diversification, and they're looking to generate higher returns. Now, despite that, there's still while there's a growing appetite for alternative investments, there's also traditional portfolios are actually still underrepresented in alternative investments. So what you have and what we've seen over the years is that the institutional investors were the early adopters here, but now we're seeing some of the retail higher net worth investors are now getting access to these strategies and are also increasing their percentage ownership. So where does this leave you as an RIA and what's the value you can add there? It really is that we believe the advisors who incorporate alternatives like private real estate and farmland can really further diversify their client portfolios and reduce exposure to traditional market cycles. So you guys are all probably well aware of the rise of alternative assets. It's well documented in the industry. The alternatives industry is on track to expand from roughly 15 trillion in 2022, and the experts say that's going to go to 24 trillion by 2028. And again, despite this growth, alternatives are still represent about 2.5% of the global financial assets that are held. One of the reasons, again, people are looking at this, rising interest rates, inflation are altering the traditional dynamics between stocks and bonds, and really incorporating alternatives can really help create a more all-weather portfolio for all of your clients. So as I mentioned previously, there's this growing gap between alternatives institutions and the average advisor-led institution. And again, one of the reasons for this has historically been access to these different types of alternative investments has been limited. Next slide. So here's a study that was conducted by Fidelity, and they really looked at 4 different types of investors and looked at their allocation to illiquid alternatives. Something like farmland, something like private real estate would be considered an illiquid alternative category. So you look at persona 1, that's an investor who's early in their career, they're accumulating wealth, and typically they're going to have a low exposure to any illiquid alternative investment. However, as that investor increases their wealth, and as they near retirement age, you're going to see the exposure to illiquid alternatives will increase to somewhere between 10 to 30% of their portfolio. So it becomes a significant percent of their portfolio as their wealth increases and as their age increases toward retirement. And you go, why does that happen? What is it that they're looking for? Returns. So they're pursuing both greater returns in their portfolio and also diversification away from equities. So the graph here demonstrates that the higher percentage of illiquid alternative investments in a portfolio, the higher the return premium over market. So you can look here and say, okay, out of 15% of my assets in illiquid alternatives, I should be able to generate about a 500 basis point increase in my overall portfolio returns. If you move that up to a 40% allocation to a liquid, that premium should jump to about 750 basis points over, again, what would be the market return. So in addition to higher returns, which is a key driver here, private real estate, farmland really provides significant portfolio diversification benefits, particularly with regard to stocks. You can see that real estate exhibited one of the lowest average correlations to the other 17 asset classes that we have listed here, including, and most importantly, including the equity markets. So when you add in the benefit of real assets and farmland being a terrific hedge against inflation, you can start to see why your clients are moving some of their portfolio to real assets like a farmland. Let's zoom in just a little bit now and talk specifically about the farmland sector when it compares to some of these other asset classes. Farmland has historically delivered superior returns, about 10.5% compared to other asset classes like stocks, bonds, and commercial real estate. And as you can see on the chart on the left, we've used the NCRE Farmland Index, about a 10.5% annualized return, and that return is very stable over a period of 20 years, 30 years, even as far as 80 years. It exceeds commercial real estate, it exceeds the S&P 500, and it greatly exceeds bond returns. At the same time, however, when you look at those, we're doing much better than bonds, but farmland also has bond-like stability. The variability of that return, the standard deviation of that return is bond-like, yet the returns are double. If you look at the chart on the right, what we're looking at there is to say, okay, if you put $1,000 into farmland in 1995, how would that have performed versus commercial real estate, S&P, and a bond index? And you can see that, that farmland outperforms all three of those other categories. And unlike equities, one of the important things about farmland is stability, is that unlike equities, it doesn't decline and have volatile downside like we saw in 2008 and 2009, and what we may be seeing again here this year as well. So some of the key points that we think about when we think about farmland, the takeaway points here, has a very low correlation to stock market fluctuation, is an excellent alternative for clients looking for a hedge against inflation. And again, this portfolio diversification aspect is a lot of reason we see our investors coming into our funds. So with that, let me turn this over to our founder and managing partner, Craig Wishner. He'll talk a little bit more about the sector, but also about what our strategy is within the farmland sector. Craig?
Thanks, Tom. That was great. Thank you all for joining us today. I'll talk a little bit about farmland and roll into the fund as well. Farmland as an asset class is a very large and actually underappreciated asset class. There is about $3.8 trillion worth of farmland in the US. And for comparison, that's about the same as all of the value of all the apartment buildings in the US and the office buildings in the US. And so it's a very large asset class. 40% of farmland is leased. So we really do consider farmland a form of commercial real estate. It has some very nice characteristics, though, that are better than the other asset classes. Specifically, one of the items is debt. There is in other commercial forms of real estate, multifamily is about 50% leveraged. Office space is almost 80% leveraged or potentially higher. There's only 13% debt on the entire farmland sector. Most farmland is completely unlevered. Some of the institutional players do use a fair bit of leverage. But fundamentally, what that means for investors is that when we have credit issues like we've had recently, you don't have a lot of farmers being forced to sell their farmland, driving down prices like you do in some of the asset classes. So it's a very stable, steady asset class. Also, food is not very economically sensitive, unlike office space, for example. Another side of the asset class as well is that the other forms of commercial real estate are very institutionally owned. Only 2% of farmland is institutionally owned. And so that means that there's not as much competition. There's a lot of opportunities to acquire great farmland at very reasonable prices. Another positive for farmland is that we lose about 2 million acres worth of farmland every year. The supply of farmland is continually declining. At the same time, population is growing, both domestically and around the world. So you have a shrinking supply of farmland and growing demand, and that's very positive long-term trends, and one of the reasons why farmland over decades has delivered around 11% annualized returns, half from cash flow, half from appreciation. Another aspect of it that is important to us is that unlike other firms that just do sale leasebacks, for example, just buy farmland and keep it as conventional, we're able to look at high value, high growing opportunities. Organic is one of those markets. So when we started 15 years ago, it was set out to buy conventional farmland, convert it to organic, regeneratively managed farmland as an investment fund. And over the past 15 years, we've seen continued growth in the demand for organic food. It's over 6% of the US food budget today, about $63.8 billion per year is spent on organic food. But the supply of organic farmland, you need organic farmland in order to grow organic food. It's only about 1.3% of US farmland is certified organic. lot of imports on that, but really a tremendous opportunity to buy U.S. farmland, convert that to organic, and serve this continually growing organic market segment. Generally, there's about a 50 to 200% price premium for organic food. Why is that relevant? Well, the value of farmland is based on the cash flow that it generates, and the cash flow that's generated is based on the value of the crops that are grown on each acre of land. So as we're converting from commodity crops, which might generate around $1,000 an acre, to organic crops, they generate $3,000 to $5,000 per acre. Permanent crops like fruit trees or nut trees or blueberry bushes, etc., those can actually generate $8,000 to $10,000 an acre or more. So lots of opportunities to add value. So when we talk about farmland, and you dig into it a little bit more, sorry, hard to avoid farming analogies there. But when we look at farmland as an asset class, we kind of break down the value components. We think about three main components: sunshine, dirt, and water. When we're buying farmland, we're buying actually pieces of sunshine, dirt, and water. Sunshine is high quality growing environments. Dirt is high quality soils that might be growing commodity crops today, but have the capability of growing high value crops as well. And then water. Water is both physical access to water as well as legal ownership over that water. So buying water rights. We think that water is tremendously undervalued. When you're buying farmland, you're actually buying some of the very first uses of water, which means you have very senior and secure water rights, which are property rights. Just like you own a piece of land, you essentially own that water as well. So very strong legal protections. And we find that we can actually buy high quality farmland with superior water rights at what we think is very low prices. Sometimes we think we're buying the dirt and getting the water for free on that. So lots of opportunities on the water side. So fundamentally, that's the first part of what we do. And then we really add value to that farmland from a strategic standpoint. So number one, yes, we're acquiring high quality farmland. And we're generally buying at least $50 million worth of farmland in one tight geographic area. We have 3 of these regions today, each around $100 million in size. And that allows us to really leverage economies of scale in agriculture. Economies of scale are one of the primary things that correlate with profitability as well. So once we acquire great farmland in a tight region, then we add value to that farmland. So we develop a 10-year crop rotation plan for that land, focusing on healthy soil biology. We get that land certified organic. We also identify land that could be converted to higher value crops, such as organic blueberries or wine grapes, etc. And then we also invest in infrastructure like water infrastructure, drip irrigation, solar, et cetera, and also add a lot of technology as well, like aerial imaging, et cetera. And then we actively manage that farmland over time. So we're managing tenants, and on some of the land, so we lease out about 2/3 of the land, and we also, in some cases, develop some acres, like to organic blueberries, and farm some of those crops as well directly. So where in certain cases, if we can farm crops and generate excess returns for the investors, it can generate extra returns. We utilize our 55-person farm management team for that. We do it all at cost. So it's not a profit center for us directly. Only if we're generating additional returns to investors do we benefit. But the key thing that we're doing is focusing on increasing margin per acre for our investors. Here's a great example of a property that we acquired in Fund 1. This is a 4,000-acre property we call Burns Farm. 4,000-acre property. We bought it for around $30 million. Today, it's worth over $90 million. When we acquired it, It what had two tenants, each who had leased half of the property, so 2,000 acres apiece, but both tenants grew exactly the same crop. So 2/3 of the land was in alfalfa, 25% was in industrial corn that went to feedlots and ethanol facilities, and then 5% was tomatoes, but industrial tomatoes for processing. So it got turned into tomato paste for pizza sauce, essentially. So when we bought it, we converted a lot of that land over to organic. It used to grow 3 conventional crops. Today, it grows 12 diverse crops on that land. It had 2 farming tenants when we got it. Today, there are 7 different farmers on that land. It was a little over $300 an acre gross margin when we bought it. Today, it's over $800 per acre gross margin per organic acre. And that number is increasing as some of these crops mature. And actually, if you look on the right-hand side, you see the crops that I was mentioning. The lower part of it, the after, we actually grow the organic blueberries on this land. We do that in partnership with Driscoll's there. So we're growing the blueberries. They're doing all the sales, marketing, and distribution on it. And that's generating today on a gross margin basis $1,400 per acre. That number is going to increase substantially as the blueberries continue to mature on that land. And then the rest of the crops are grown by tenants. So we have tenants growing organic green beans, sweet corn, watermelons, squash tomatoes, etc., paying us a flat rent of $775 an acre. So this is where generally we've increased that land from $300 an acre to $775 per acre. Tenants have also planted olives and almonds on sections of the land, and there we get a revenue share. So as those crops mature, for example, in olives, we're getting over $1,000 per acre. It's a $350 an acre base rent plus a revenue share. So these are really doing well without any CapEx on our part. Great example of how we are actually managed farmland. This is what we do at a larger scale. Our average tenant leases around 1,000 acres of land from us. This land is all leased out. The farmers want more acres. This is one of the reasons why we're doing Fund 3, so we can buy more farmland, convert it to organic, and continue to help these tenants grow their organic business. So not only are we delivering on the financial side, we're also one of the top-rated impact companies around. We had one of the largest ESG ratings firms who does the ratings for MSCI, and they came in and did a 3-month analysis with us, and they score their companies. So they've done over 10,000 companies. They score you out of 100 points. 50 or below, you're doing bad for the planet. 50 or above, you're doing good for the planet. The average agricultural firm that out of 10,000 has an average score of 17 for them. On the other hand, we received the highest score that they've ever given to any one of their 10,000 companies. We received a score of 82. And so this is for your clients who care about this stuff. We have a great 10-page report that was prepared by them. That's very easy to send out. So this way, investors get both a high quality, uncorrelated, stable and secure asset, plus the impact that they're looking for. Typically in the family offices that we're working with, the older generation cares about the financial side more, and the younger generation at this point cares more about the impact side. So we're able to provide both. So our Fund 3 is a $250 million fund. We've already raised $100 million of that. We've already purchased about $62 million worth of that in 2 nice transactions. And in fact, one of those transactions, they mentioned earlier that we were going to be named as the Farmland Manager of the Year. Well, this same report is also saying that one of our acquisitions was the runner-up deal of the year in the Americas. And this is a leading agricultural media outlet. So very happy about that. We're able to buy great farmland. We also have another $42 million of properties under LOI, and that's also a single transaction as well. Multiple farms in a single transaction. This is a great time to be buying farmland. Some of the institutional investors, so we're one of the 14 largest farmland managers in the US, but we're the largest focused on organic and regenerative agriculture. Some of the larger institutional investors used a lot of debt, and they're being kind of forced to sell by some of these higher interest rates. That's just creating some opportunities to buy very high quality assets at lower prices. In fact, the assets that we bought, both of the assets have been around 15% below the appraised value as of the date that we acquired that property. So we're very happy to be buying these properties right now. We're also very pleased to have Microsoft join us as an investor very recently. They're an investor in the fund alongside all the other investors, and they are acquiring, they want to buy the carbon credits that we produce from our farmland. So they're getting both a great investment and it'll result in increased revenue for our investors when they buy the carbon credits, increasing the returns and also helping Microsoft get to net zero as they grow. We're very pleased to have Microsoft join us. They did extensive due diligence, and that will likely help with your investors' due diligence as well. So with that, I'd like to pass it back to Tom.
Yeah, thanks, Craig. We believe that many of your investors are actively looking for an investment with the risk and return characteristics that farmland can offer. Our Farmland Fund 3, offers your clients an opportunity to invest in a proven strategy in a stable asset class with a very compelling risk and return profile. Uncorrelated with the equity markets, an investment in farmland offers portfolio diversification. It offers a hedge against inflation. And as Craig mentioned, it also offers an opportunity for your investors to invest in an investment aligned with their values. So with that, we're going to turn it over back to Ronnie. Please feel free to ask questions. And Ronnie, why don't you manage the Q&A going forward here?
Thank you so much, Tom. Thank you again, everyone, for joining us today. Before we get started, just a quick housekeeping note. I encourage everyone on this webinar to continue to submit your questions in the Q&A section below. And we'll also follow up with each of you individually with a replay link of the webinar and materials regarding the winning of our Farmland Fund Manager of the Year and Farmland Deal of the Year runner-up. So with that, we'll go ahead and kick it off with the Q&A. First question is for you, Craig. Okay, so the federal government seems to have an interest in controlling how water is used, especially in certain states like California. What risks does a more activist federal government pose to water rights and farming?
Great question. We love water rights. We're kind of experts in water rights. It's a very interesting topic, and one of the things that makes it so interesting is that the water rights are actually controlled west of the Mississippi. The water rights are actually state water rights. So like the state of California, for example, effectively as part of the Constitution in 1850, not only is land private, not owned by the state, but water and mineral rights are also private and owned by the land. And the water rights are determined by who used it first. So when in the 1850s, when people were farming land in the US, in California, and irrigating their ground, they were actually securing some of the oldest and most senior water rights. The state of California didn't, so around 1914, it realized it didn't have any control of the water. And so it said, hey, you know what? We will control all the water not yet allocated. So 1914 is the date that separates the senior water right holders from the junior water right holders, people who own water, who got water after 1914, subject to state control. So when you hear the state say, oh, you need to cut back water, they actually have to cut back the junior water right holders to zero, so that the senior water right holders get 100% of their land. The federal programs come in, and so the state actually built a number of dams and reservoirs, and they basically control those dams and reservoirs. So they have to release the water to serve the senior water right holders and the environment first, then the junior water right holders. The federal government also built different dams and reservoirs, and it's a limited number of them. And those are the ones that the federal government can try to release, or were ordered to release some water from. It's a minority amount of water. It also is, to the extent that it jeopardizes the senior water right holders, the federal government is susceptible to the senior water right holders. It can be a litigation issue, but we don't consider it a long-term issue. There is just a little bit of noise on that right now. But again, fundamentally, it's a private property right. And we have, for example, independent standing to sue in order to protect those rights. But there's also water districts and large organizations that protect it. Sorry, long answer. It's a complicated topic, but fundamentally, it's each state is different, and it does get politicized a little bit. But there's also just the firm constitutional law around private property ownership in the United States. That's the fundamental bedrock of water rights. That's why we love buying farmland with great water rights, because of its very secure, it's just a wonderfully secure way of buying water.
Perfect. Thank you, Craig. The next question, do you have a deck that you can send out? I can go ahead and take that. We certainly do. Please reach out to us at irteam@farmlandlp.com, and I can send, one of us on the IR team can send you a investor presentation for your use. Thank you. The next question is, what is the minimum investment amount? Tom, that's for you.
Yeah, happy to address that. So our minimum investment amount varies by the type of investor. For the institutional market, it's $1 million. For our family office, small family office, accredited investor, we have it at 100,000 as a minimum investment. However, if they are working under a wealth advisor or an RIA like yourself, we're willing to push that number down to about 50,000 so that they can kind of test the waters there. A couple of other terms that are important about the fund that I think are worth noting. As Craig said, it's a $250 million fund. We're about 40% completed on that. Our structure is an LLC with a corporate blocker. That means no K1. So from a tax perspective, it's super easy. The only time they're going to get a tax form would be a 1099 div form, and that would be only in years that we do a distribution. Our target returns for the fund fall into the 12 to 13% net return wise, and on a cash basis, it's about 2.5 to 3x cash on cash. Our funds are standardized now to 10-year terms. So this fund started in late 2023. So first expiration date would be 2033. We do have 2 one-year extensions on that. And we are restricted to accredited investors only in Fund 3. Long answer to that one, Ronnie.
Great, Tom. Thank you. Do your investors, this one's for you, Tom, do your investors receive any monthly or quarterly income? When do investors receive their principal back? And also, do investors only receive appreciation? If so, over what term? So we can break that up.
Yeah, sort of 3 questions there. So when you look at that 12 to 13% net return, roughly 40 to 50% of that is expected in cash distributions during that 10-year time frame, and the balance of that does come through appreciation of the farms in the fund. Our cash, when you look at cash flows over 10 years, we're a value-add commercial real estate strategy. As Craig said, we're buying these good quality farms, but we're doing improvements to drive higher cash flow and to drive greater appreciation. That means in the first 3 to 4 years, don't expect cash distributions. We're using that cash to make those improvements to drive higher cash returns in the second half of the fund. So when you look at our model, and we can share extensive projections with you, we're kind of looking at cash becoming available for distribution starting in year 4 or 5, and then increasing as we go through toward the end of the 10-year period in the fund. And again, thinking about those returns, 50% in cash and the balance in appreciation.
Thank you. Craig, this next question is for you. What climate risks are you considering, and how are these factored into your economic modeling?
That's great. So I didn't talk about that when we were talking about sunshine, dirt, and water, but not only are we making sure that we have a good growing climate today, but we also very much incorporate climate models going out to 2050 and 2100. So a very first screen that we do on the fund is identifying regions that when you really understand the climate models, you see that certain regions in the US and the world are going to be very impacted by essentially heat and water issues. And other regions are actually going to stay the same as they are today, or even potentially get better as well. And so as a fund, we actually screen out all regions that are projected to be negatively affected from an agricultural perspective from climate, and only invest in regions that will stay the same or even get better. So they're good today, and we think they're going to be good well off into the future. It's one of the key background elements for us that have us also buying irrigated farmland that have great water rights today, because we think that water rights are going to get much more valuable in the future as certain regions have issues. So yes, we have very strong climate science that goes into where we buy farmland and the kind of farmland that we buy. And we think that's a key driver for farmland value in the future. We've actually seen it over the past 15 years where we don't invest, for example, in the southern part of California, and we are buying farmland in the Pacific Northwest. And we've seen a lot of farmland when there's water issues in the southern part of California, actually relocating operations and growing more crops in the Pacific Northwest. So we're already seeing evidence that this is a good strategy.
Thank you, Craig. This looks like our final question, and it's also for you, Craig. What are your thoughts on the potential impact of the new administration and their desire to gut federal programs generally, but specifically those dealing with climate change, regenerative farming, and sustainability? How dependent is Farmland LP to those programs that support organic farming via the USDA, ORG, and TOGA?
Great question. So when we started 15 years ago, we assumed, and at the time, there's basically no support for organic agriculture. So didn't qualify for crop insurance. There weren't really grants at the time for the cover crops and the other things that we do around organic conversion. And actually, over the past kind of handful of years, we've become eligible for crop insurance, and there have been a lot of grants to do some of the things that we do. Again, the business was set up to basically not be dependent on that, and it's nice to have the crop supports that they give to conventional corn and soy as well. And we do like it, and it is an improvement. The way that crop insurance works is that the reason why we didn't have in the beginning was that you need at least 10 years worth of growing history for that particular crop in that particular climate, in that particular county. And if you have that 10-year track record, then kind of automatically becomes eligible for the crop insurance. And the government pays over 60% of the crop insurance premium. They backstop all these programs really from a fundamental government obligation to make sure that their citizens are fed every day. So you can't really mess with the food system if you want people fed, and crop insurance is a key component of that. If if they wipe away the grants and do some other things, it would basically take us back to how we were 15 years ago, which is fine. The key things that drive the value of our business is the scale and the high quality farmland that we buy. We also a lot of our food is actually consumed domestically. So we serve domestic markets. So if tariffs go into place, that would actually make imports more expensive and actually to some extent be beneficial to us. It's a pretty, we do see there's a lot of noise. We kind of, when we're asked about tariffs, we say, well, what day is it today? Because the news keeps changing on it. But well, we actually feel that we're pretty shielded from a lot of the dynamics associated with that and kind of politics in general. Food is not really political. People need to eat, and that's fundamentally what drives the returns on our farmland and its long-term value.
Wonderful. Thank you, Craig. Thank you, Tom. And thank you everyone for joining us today. This concludes our presentation. Thank you for joining us and taking the time out of your busy days to join this webinar. If you have any further questions that you'd like to ask, if you'd like to connect with us, our email is irteam@farmlandlp.com. We look forward to sending you a replay link of this webinar and connecting with you at a future date. Thank you.
Thanks, everyone.
Thanks, everyone.